Excuse me. Now, let us look at anti-money laundering risk governance through the lens of the regulators. Now, the regulators look at the enterprise-wide risk. The banking regulators look at the enterprise-wide risk management of the bank. Now, this includes the governance itself, as in the role and responsibilities of the board of directors. Now, the board has got the main board charter, it has the board risk committee charter, and it has the board audit committee charter. Now, these are documents that are informing the responsibilities of the board of directors. Now, these documents must articulate the role of the board in anti-money laundering oversight. Now, what this means is that the board must approve the policies, processes, and procedures, and the board must delegate implementation of those policies, processes, and procedures to senior management. That must be clearly articulated in the board charter, in the board risk committee charter, and in the board audit committee charter. For the board audit committee charter, of course, we are saying that the audit responsibilities of the board also include the assurance responsibilities of the board also include all the risks in the bank, including AML risk. So when we audit the compliance department and when we audit the risk department of the bank, we will have to look specifically on all the risks, including AML risk. So the procedures for auditing AML risks must be clearly articulated in the board audit committee charter. Now, with respect to risk appetite, we can say that the board must articulate risk appetite for all the risks, including AML risk. Now, there are two things about risk appetite. There is what we call the risk appetite and the risk tolerance. Now, the risk appetite for the bank can be larger, okay, meaning the bank can withstand a large shock, okay, but the risk tolerance of the bank may be lower, even if the bank can withstand a large shock in terms of a risk event. The bank can only withstand, the bank is only willing to take a smaller amount of shock. Now, that would be risk tolerance. The board can withstand a larger shock, that is the appetite. The board is willing to take a smaller shock, even if it can withstand a larger shock. Now, that is risk tolerance. So the board must articulate the risk appetite of the bank in qualitative terms to say whether it's low or whether it's moderate or it's high, and the board must articulate risk appetite in quantitative terms, in terms of risk tolerance. So in quantitative terms, the board, the risk appetite statement can be, for example, the risk appetite statement can read like this: the bank's risk appetite statement for anti-money laundering risk is low. That is qualitative, and that is risk appetite. And then the risk statement can further proceed to say the bank is not willing to lose more than X million amount of US dollars should such a risk event occur. Now, that is tolerance. The bank, so you articulate risk appetite statement in qualitative and in quantitative terms. And by definition, you will see that risk appetite statement must be articulated in terms of the risk appetite itself, and risk tolerance. Now, we have the risk policies. The bank must articulate policies, procedures, and processes for each and every risk that the bank is managing. In terms of AML risk, we understand that an adequate anti-money laundering compliance policy or compliance program constitutes 4 components, and these are the internal controls. These are the bank must institute audit on AML risk systems and practices after 12 to 18 months. The bank also must, in terms of risk assessment, the bank must articulate methodologies for measuring anti-money laundering risk. In this case, the analysts, the anti-money laundering analysts, do not have to come up with their own models. The board is responsible for ensuring that it approves the risk assessment models or the risk measurement methodologies that the bank is using to measure AML risk. Now, largely the risk scoring model is used for AML risk. However, you can use other models. Now, we also have the bank must approve common risk language. When we are talking about risk in the bank, we must have a common risk language. Now, we have this risk register. The bank, the board, especially the board risk committee, may want to review a summary of the risks and how the risks are being managed in the bank. Now, let us speak about AML risk, which is part of compliance risk. In terms of AML risk, when we say the impact may be high and the likelihood may be high, but the bank can undertake risk mitigation measures. And with compliance risk, we can say the bank has tools needed to monitor compliance risks and to comply with. So the bank needs to have those tools to manage compliance risk. Yeah. But with respect to AML risk, which is part of compliance risk, the bank may have to develop policies, procedures, and processes to reasonably protect the bank from risks associated with anti-money laundering. Yeah. So the impact may be high, and but after the risk mitigation measures, you may reduce the likelihood. You may not reduce the impact. You may reduce the likelihood. So for managing risk, you may want to reduce the impact, or you may want to reduce the likelihood, or both. And in this case, it would be difficult to reduce the impact because, however, you may reduce the likelihood, and therefore reducing the AML risk. And to this end, the proposed action would be to carry out ongoing risk assessment process to address the varying degrees of risk associated with its products and services, its customers, and geographical locations. The banking regulators would also want to see that the board has established first line, second line, and third line of defense systems in the bank. Now, let us look at risk strategy. The bank has about 8 or more strategies that the bank can employ to manage this risk. The bank, to manage AML risk. The bank can employ AML specialists in the compliance team, for example. The bank can upskill staff. The bank can invest in training, and training should be ongoing. The bank can improve its AML policies and procedures. This may entail ongoing review of the 4 components of an adequate AML compliance program. The bank can increase AML process controls. Now, for example, ongoing review of processes and data patterns. information sharing with industry participants and so on. The bank can perform model-driven validation. This, in essence, speaks to managing model risk, because you have a model for measuring AML risk, and that model involves data that you input into the model so that you can effectively make decisions in terms of, so the model will tell you who a high risk customer is and who a low risk customer is. And based on that, you will allocate resources. More resources will be allocated to monitoring high risk customers. But if your model is telling you wrong, the model is painting a wrong picture, it's not able to tell you effectively who a high risk customer is, then the model is wrong. It's a garbage in, garbage out kind of environment. So you may want to validate that the model is actually working for the bank. You may leverage consultancy experience by engaging specialist AML consultants. They offer a quick fix. Okay, consultants will be engaged because the bank either lacks expertise or the bank does not have the time, as in the bank staff are engaged in the day-to-day operations of the bank. Therefore, an expert can come in to fix a particular problem, and you can leverage that consultancy experience in that regard. You can transform AML compliance operating model. By this, we mean that you can have third-party organization managing the KYC processes of the bank and so on and so forth. Or you can hire data scientists to support data analytics and predictive modeling. Now, by this, we mean you may want to employ AI and machine learning into the machine learning tools in the AML risk management space so that you can effectively manage that. As a matter of fact, it's a no-brainer. You just have to go AI nowadays. Or you may have a multi-pronged approach by employing two or more of these options to manage AML risk, and this is what I would largely recommend that any institution does. Now, let us look at the internal controls, the risk management part of it. Now, a bank is exposed to AML risk because of the different types of customers, because of the bank's different types of products and services, and because of the geographical locations in which the bank operates. Now, with geographical locations, we have the help of the Financial Action Task Force that has designated jurisdictions that are high risk and that are moderate risk and that are low risk. High risk are in the blacklist of the Financial Action Task Force, and there are 3 countries currently: the Democratic People's Republic of Korea, Iran, and we have Myanmar in there, formerly Burma. The gray list, these are institutions that are working with the Financial Action Task Force to improve the AML regimes of those jurisdictions. And amongst these countries in Africa, we have South Africa is there. Nigeria is working with the Financial Action Task Force to improve the AML laws, policies, procedures, and so on. Tanzania is also there. We've got Uganda, surprisingly, the United Arab Emirates. So these countries, when we're inputting our data in the AML risk model, as we shall see, okay, the gray listed countries are moderate risk countries. The blacklisted countries are high risk in terms of geographical locations. Those that are not listed are low risk countries. So, Let us look at uh, the model itself. One of the sources of AML risk for the bank is the type of customer. Now, this customer may be a natural person or a legal person. Now, for every customer, we're going to have to, each type of customer, we will have to carry out a risk assessment. And we have the factors such as source of funds, honesty, integrity, and reputation, the purpose of the account, economic sector, ultimate beneficial ownership for legal entities, geographical location, all these risk components we will have to evaluate the risk factors in order to arrive at the final risk score in terms of whether the customer is low risk, high risk. Or now the different types of customers include natural person, and there are natural persons that are deemed politically exposed persons. We have legal persons such as business entities, non-bank financial institutions, professional services providers, cash-intensive businesses, NGOs and charities, embassies, and foreign consulates. Now, we also have to conduct a risk assessment of the particular products that the institution has come to access from the bank. Now, we have risk factors that we measure for the type of product, and these may include volatility of funds, the factors such as customer relationships, geographical locations, loan-related parties for lending activities. We have actual versus expected transactions, and we have volume of transactions and all the other factors, as we shall see. However, this training is broad oversight training, so we shall not delve into the discussing the risk factors for that. That is this kind of training we offer to banking operating staff. However, we shall discuss the risk factors for different types of persons, just to give the board an understanding of how the risk assessment, the AML risk model operates. Now, for customer risk assessment, we shall analyze, or we shall evaluate the risk factors pertaining to a customer, whether natural person or legal person, and then we take the risk factors as with respect to the types of products and services, and then we find an average of this, and that is what we shall take as the overall risk score for the customer. And the score is going to inform us whether this customer is a low risk customer, a moderate risk customer, or a high risk customer. Now, let us look at, for example, natural persons. Assessing the AML risks associated with transactions involving accounts held by individuals. These are natural persons. You can see that for natural persons, we have two customer-specific risk factors, and these are source of funds. For the natural persons, we want to understand the source of funds. We also want to understand the honesty, integrity, and reputation of this customer. By honesty, integrity, and reputation, we mean we want to understand whether the customer has been convicted of a financial crime before, whether the customer has been investigated but not convicted of a financial crime. We also want to understand whether the customer has never. If the customer has been convicted of a financial crime before, then such kind of a natural person is a high risk customer. And if the source of funds, for example, seem dubious or seem suspicious, that would be a high risk customer, and we will score 5 on source of funds, 5 on honesty, integrity, and reputation, We will also add a score of the product that the customer is coming to access from the bank, and an average of that will inform the overall risk profile of the customer. Now, after understanding the risk customer or the risk profile of the customer, what it is that this will inform the internal controls that we're going to apply. If a customer is low, the internal controls will be, for example, standard account surveillance as according to record keeping regulations and ongoing due diligence. So we shall keep the records of the customer in terms of transactions. We shall also carry out ongoing due diligence. By that we mean the risk factors as measured when we are onboarding the customer may change during the tenure of relationship with our customer. So we will keep updating that, and a customer who was once a low risk customer may become high risk customer depending on how the measurements of those the risk factors change. If a customer is a high risk customer, we shall apply special account surveillance as according to high risk customer regulations. Now, largely, AML regulations will provide for controls relating to high risk customers, controls relating to low risk customers, and controls relating to moderate risk customers. With customers that are profiled as moderate risk customers, we will apply special monitoring of certain transactions. Of course, regulation will largely sort of dictate what the bank requires to do when a customer is profiled as such. We have the politically exposed persons who are now referred to as prominent influential persons. Now, a politically exposed person, by definition, involves a high-ranking official of a major political party, a high-ranking official of we will say the executive branch or members of the executive branch of government, or high-ranking officials of state-owned enterprises, of the military, maybe from colonel going up in the military, of the judiciary, the judges, and other. Now, this also includes their close associates, their spouses, their children, their siblings, their parents. So you see that the universe of politically exposed person or prominent influential persons is quite larger, and the bank really has to, the board must ensure that they have the necessary tools to be able to establish whether this customer is a politically exposed person or not. For example, some politicians are well known, some high-ranking officials are well known. This person works in the bank, the relationship manager automatically knows this is a politically exposed person. However, you may not know if somebody walked in the bank wanting to open an account to know whether this is politically exposed or not. The anti-money laundering analysts behind the scene will have to carry out research and establish whether this person that the bank wants to onboard onto the client portfolio is politically exposed or not. Now, for politically exposed persons, there is only one rating worldwide. Politically exposed persons are high-risk customer, period. And what the anti-money laundering laws say, or international best practices say, is that the bank the senior management of the bank must approve account opening for all high-risk customers, for all politically exposed persons. So we must see in the board minutes that the bank has approved accounts for politically exposed persons. If the bank has not done that, then the bank may want to do that. Otherwise, the bank is not fully compliant with the laws and regulations, and that risk can come to, I mean, the chickens can come home to roost. So, with politically exposed persons in terms of internal controls, there is only one: special account surveillance as according to high-risk customer regulations. Now, with embassies and foreign consulates, what we have are about 4 risk components, and these are purpose of account. Some embassies will carry out transactions on behalf of individuals, of the nationals, their nationals. Now, if an embassy is carrying out transactions in its bank account on behalf of its nationals, then effectively the bank does not know who it is doing business with. That would be a high risk environment. Now, to manage this risk, the bank may want to enter into an agreement with the embassy, to where the embassy sort of agrees that it will not carry out transactions other than the transactions of the state, as opposed to transactions of nationals of the, and also the actual versus expected transactions during account opening. Largely, you will find on the bank account application form there is what an applicant will have to state the expected transactions or amount of transactions in terms of volume. Now, the bank is going to look at the actual versus expected transactions, and if there is a large variance, then that would be flagged as high risk. With geographical location, we will have to look at whether this institution is coming from the grey list of the Financial Action Task Force or from the blacklist, and we shall rate this factor 5 if it's blacklist, and 3 if it's grey list, and if the country is not appearing on any of those lists, it will be low risk. And the banking product, of course, is one of the things that we are going to have to rate, to input in the model for us to establish whether the customer is a low risk, moderate risk, or high risk. Now, in terms of internal controls, when we establish that, we are going to, of course, apply the internal controls as according to anti-money laundering laws. With respect to non-bank financial institutions, we'll have to look at the ultimate beneficial ownership. Now, with ultimate beneficial ownership, we're talking about the person that ultimately controls the bank. We are looking at the natural person that ultimately controls the institution. Now, the person that ultimately controls the institutions may not necessarily have shares within the institutions. They may have shareholding, or they may not have shareholding, or they may have shareholding through proxies, and so on and so forth. So this is a larger topic, and that we can discuss another time. But ultimate beneficial ownership, we need to establish the natural person that is controlling the institution. And once we know who that person is, we have to carry out an integrity test to establish whether that person has the integrity and the reputation that is favorable. Now we will score this component 1 if it's low risk or 5 if it's high risk. The purpose of account: the non-bank financial institutions can be carrying out transactions of its customers through the bank account. So if it's stated that this is for the purposes of the transactions of the institution, that would be low risk, because supposedly the bank would have more understanding of that institution. But if the account is for purposes of the clients of the non-bank financial institution, now that would be a high risk scenario, because so we will rate this as high risk because the bank effectively will be carrying out transactions through the account of people it does not know. We will look at the actual versus the expected transactions on the account, and we will rate it high risk or moderate risk or low risk. If the non-bank financial institution is headquartered in a country that is in the grey list or in the black list, we shall rate as such moderate risk and high risk. The banking product that the institution is accessing in the bank, and also we shall rate the AML compliance policy. A non-bank financial institution client of the bank must provide the bank with its AML compliance program. And when we evaluate this program, if the program is weak, we are going to rate this component 5. And if this program is strong, we are going to rate it as 1. Now, we take all these components and we take the average of this, and then we have the risk score for customer specific anti-money laundering risk score. Now, this client may be accessing several products within the bank. Now, each of these products have inherent risks with respect to anti-money laundering risk, and that the average of the products, that is the risk score that we're going to put in product specific risk score, and this will inform the risk profile of the client in terms of AML risk. And then we're going to apply the internal controls as according to AML regulations. With respect to professional services providers, we will look at ultimate beneficial ownership. We will rate that. We will rate the purpose of account. We will rate expected versus actual transactions. We will rate geographical location. We will rate banking product. We will also rate AML compliance policy. All professional services provider clients of the bank must have an AML compliance program, and they must avail that program to the bank. Now, professional services providers will include chartered accountants or public accountants. It will include lawyers. It will include management consultants such as ourselves, and so on and so forth. And when we establish that risk profile, we will apply the internal controls as informed by regulations. Non-governmental organizations, we will have to understand the ultimate beneficial owners, as in the founders of the charity. We will look at their honest integrity and reputation. We will look at the donor base and carry out sort of background checks on the donors. We can say the largest 20 donors of the institution and establish who these large donors are. If they are individuals, we will want to establish their honest integrity and reputation. If they are institutions, also we may have to carry out ultimate beneficial ownership checks on the donor base. Also, we will look at the expected versus the actual transactions, the geographical locations, we will rate that as such, and the banking products. We will, after all these factors, we rate them from 1 to 5. We will get the average to inform the customer specific risk score, and then we will look at the products that these institutions are accessing in the bank and measure them as such and arrive at the risk profile of the institution. Okay, excuse me. Hi. Okay. I'm making a presentation. All right. Okay, sorry, we had a knock at the door there. Now, we will apply the internal controls as informed by the applicable institution. With business entities, we will look at ultimate beneficial ownership, actual versus expected transactions. We will look at the geographical location, and we will establish the risk profile, and the risk profile is going to inform the internal controls that we apply. Now, I want to mention with cash-intensive businesses that with cash-intensive businesses, we've got one aspect we will look similar to business entity. However, there is consistency of transactions, because with cash-intensive businesses, the risk is that the cash deposits may be commingled with deposits with funds generated from illicit activities. And so if we have a restaurant at this corner and a restaurant at that corner, and we see that the deposits of these restaurants are far much more higher than the deposits of the other restaurant in the corner, well, that may be a red flag per se. We may want to establish the cause of that. It may be that these guys in this corner have got more customers than the other guys. We may even want to carry out visits just to check on whether these guys have got more customers than the other guys, and we may conduct other checks, or we may have other due diligence measures to establish the reason why these guys are in the same street, but one is depositing higher amounts of a higher volume compared to the other party. Yeah. And then we will rate consistency of transactions or transaction volumes, whether it's low risk or whether they present a high risk for the bank. And we will apply internal controls as such. Now, that is a risk model per se. We will carry out a customer anti-money laundering risk assessment for natural persons and for legal persons. We will carry out anti-money laundering risk assessment for types of products and services, and we will establish a risk profile for the institution. But now let us speak to the suspicious transaction reporting responsibilities of the board of directors. Relationship managers will collect the data required to input in our model. Of course, they will use the tools such as the bank account application form to collect that data. The relationship managers and or the AML analysts will carry out the identity verification procedures. And of course, this is through third-party checks, such as verifying with the identity issuing authorities. Largely, these are government authorities. The AML analysts will carry out customer risk assessment procedures in terms of they will input this data in the model that the bank is applying, such as, for example, the model we just discussed. And they will carry out surveillance based on the results of the model in terms of whether we will have to monitor high-risk customers closely as opposed to low-risk customers. And where we see a suspicious transactions will be filed with the authorities as such. The board of directors is responsible for all this cycle, and this must be clearly articulated in the board policies. Each step must be clearly articulated in the board policies. As we mentioned, the first three steps are the KYC policy of the bank or the Know Your Customer policy of the bank. Now, When it comes to automated surveillance, the board is responsible for providing the AML analysts with the internal research tools, which include access to account systems and account information, including customer due diligence and enhanced due diligence information, to assist the analysts. Because how would an analyst check whether the actual versus the expected transactions are sort of divergent or they are okay? Okay, it's through access to the account systems of the customers. The board will have to provide AML analysts with external research tools, okay, which include widely available internet media tools as well as those accessible by subscription. Okay. After thorough research and analysis, analysts shall document conclusions, including recommendations whether to file a suspicious transaction or not to file a suspicious transaction. And the decision whether to file a suspicious transaction is, of course, is after thorough research. When a transaction is flagged as suspicious, we do not just go ahead to file it. We may want to carry out preliminary research, including finding out from the account owner to explain the reasons for what has been observed on the account, and then a suspicious transaction report completion and filing process takes place. Now, in my country, we have Section 29 of the Financial Intelligence Center Act and the Bank of Zambia Anti-Money Laundering regulations that clearly specify how that suspicious transaction is going to have to be filed. And lastly, we notify the board of directors that the suspicious transaction report has been filed. These are the responsibilities of the board of directors. This is the anti-money laundering training program for the board of directors. Thank you.